Hi there, Mike Brady with Generosity Wealth Management, a comprehensive, full-service wealth management firm headquartered right here in Boulder, Colorado. And today I want to talk about 2013, 2014. We're going to go over some graphs and charts together. I'm going to walk you through it. I also first want to talk about the big picture. Now, I'm going to use an analogy here of someone who wants to be healthy in their body, maybe lose some weight, be generally better fit. They might go to a nutritionist and set up a goal about how much they want to lose by a certain point in time. My experience has been that those people who lose that weight and consistently meet their healthy goals are sometimes the most disciplined individuals. They know where they're going. They make tweaks and adjustments along the way, no question about it, but they're very, very disciplined. And the reason why I bring that up is it's the same way in the financial world, in my experience. 20 years ago, I did financial plans for people. And some people now that we fast forward to today, some people have met their goals and some people have not. And those that did not meet their goals usually was not because they didn't, they bought mutual fund A or mutual fund B, or they didn't, they bought the wrong investment. It usually was because they weren't quite as disciplined as the person who has now met their financial goal. The person who has met their goal knew where they were going, they had that financial plan, they stuck to it, and they didn't get too sidetracked by the bright, shiny object, sort of like with that health person, someone who knows what they're doing and sticks to it, but they're not going to the popcorn diet one week or the pumpkin diet the next, or maybe even the grapefruit diet, whatever the National Enquirer diet of the week was. Well, the financial world is very similar in that they absolutely make tweaks along the way, they make some adjustments, but they're also quite disciplined and understand that they're trying to get to a goal with the least amount of disruption along the way. Okay? Now, the reason why I bring that up is 2013 was a year where if we could rewind it 12 months ago, we would say let's go 100% into the unmanaged stock market indexes, or the stocks of some type, because they did very well in 2013. The Dow to the S&P, which are unmanaged stock market indexes, between 26 and almost 30%. Okay? So one of the tendencies is, I think, for people to say, wow, I've got to have all this equity exposure going into 2014 or 2015. And the discipline in us needs to say that is not the reason why you do it, because why you would go into a higher equity position for 2014 and 2015. It also is not very helpful to say, oh gosh, I should have had it, lament, and I meant to do it, and I should have do it. I knew it was going to be a good year. We don't know that. That is all mental head garbage about what was known at that particular point 12 months ago. And in the construction of a portfolio, let's keep in mind that each client, and you are one of those people who are trying to get to a certain point in the future, and we need to keep disciplined as we're going towards it. In this past year, you've got stocks and you've got bonds, and you usually mesh them together like this. You might have other kind of satellites around there, whether or not it's real estate or gold or other types of maybe satellite investments from your core investments. And sometimes the stocks bring up the whole portfolio. Sometimes the stocks bring the whole portfolio down. In this year, the stocks brought it up. The bonds kind of brought it down. And depending on your percentage allocation between stocks and bonds, because each investor is different with their particular goals and objectives, things of that nature, depends on what your rate of return was for 2013. Bonds did not do well last year. Last year was one of the worst years for bonds in a very long time. And so in hindsight, you wish you had zero bonds. But no, it still makes sense for you to have an allocation of both stocks and bonds. It's my belief that bonds were actually oversold, and it still has a great place in your portfolio. Now, I'm going to throw a chart up on the screen there. What you're going to see is for 2013, that green right up there, junk bonds did really well. It also correlates very highly with the stock markets. Beyond that, pretty much all the bond indexes were negative, whether or not that was muni, whether or not that was treasuries. Pretty much all the bonds were negative for last year. Now, why did 2013 turned out to be so good for the equity markets? Well, as we look back at it, what you're going to see is there's some hurdles that were removed. You've heard me for a long time talking about the continent of Europe and all the issues that are there. Well, the European Central Bank made some overtures that they're going to help backstop some of the government problems. It hasn't come through yet, but they have said that, and the European markets last year did very, very well, in the 20s as well, 20% in general. Even though the economy is growing very slowly. So there's a disconnect between what the economy is doing, but also what their stock market has done. And that's a real key thing that you're going to hear me say a couple times here in this video, is what the economy is doing does not necessarily equate to the performance of the stock market, either good or bad. We also had a lot of fiscal cliff issues this past year, but they really had a minor impact. I mean, 10 out of 12 months last year were positive for the stock market. So that tailwind has helped. Plus, we need to look at the financial profit and growth. I mean, expenses are very low in companies. Their profit margins are very high. Look up at that sheet there, and I've put on there the corporate profits, and right there at the top there, profit margins are very high, which I think is good, and I think that bodes well going into 2014 and 2015, particularly because of the amount of cash that has been kind of thrown into the markets through all of the quantitative easing and all of the Fed action. One of the things that we're going to hear an awful lot about in 2014 is whether or not there's going to be a tapering. And I think that if things continue as they have been going for the last 6 to 12 months, we're going to hear more and more about that tapering. But if December has shown anything, the tapering has already started, and there was not an effect. The amount of cash, I think of it as a bowl. We put lots of money in. Just because we're not putting more money in doesn't mean that all the money that is accumulated in that bowl just automatically evaporates. No, it's still there, ready to be invested, ready to be loaned out, etc. In 2013, we also had a lot of stock buybacks. We also had a lot of dividends and earnings that were distributed. So it was just an absolutely a great year for the markets as a whole, the stock markets, that is. I wanted to show you this next graph here, this next chart, is the S&P 500 price to earnings ratio. That's something that you're going to hear an awful lot about going forward. Right now, you can see that it's at 15.4. That's the price over the earnings. And earnings went up, but prices went up quicker than earnings. So the number has gone up. It is higher than it was a year ago, still below the 15-year average. Now, that 15-year average also includes those crazy 97, 98, and 99 years when the S&P PE ratio was in the 30s and the 40s. I remember those times, and it was, crazy. You're going to see that from a real earnings, that chart up on the screen right now, that the earnings of the trailing, it is still cheap. I mean, the reason why that number is going down is only because it's relative to the price, and so the prices have gone up faster, but it's still relatively cheap. You can see that dotted line. When it gets below that dotted line is when it starts to get more expensive. Now, you've heard me talk about the bond markets doing poorly last year. There was a 70% increase in the 10-year yield in 2013. Now, you don't need to know everything about that yield. I have to admit, I'm a little bit of a 10-year yield nerd. I love to watch it on a daily basis. And when the yield goes up, the reason why the yield has gone up is because the price of the bonds have decreased. Now, here is a long-term trend, but in 1 year, it really spiked up. You can see it right then and there. And then you might say to yourself, oh my God, it's at almost 3% right now. If it continues to go up, well, the stock market obviously is going to go down. That's not necessarily the case. look at this next chart here, and what you're going to see, and I'm going to kind of put some arrows there about where we are right now, that's the correlation, meaning a correlation of one means they two things move exactly the same way. So if one goes up, the other goes up an equivalent amount, that's a correlation of one. If one goes up a little bit, 10%, let's say, and the other one goes down 10%, that's a negative one correlation. So the correlation is still positive, meaning that when one goes up, the other continues to go up as well until the 10-year yield gets to be about 5. And then there seems to be a real opposite between what the bonds yields do, which is based on a bond price going down, and the stock market price going down as well, as money is flowing into those bonds to get the higher yield. Let's talk about what happened in 2013 for the global markets. You can see that European, Australian, Far East did very well last year, just like Europe did, Pacific did, and emerging markets did not do as well last year. But what is interesting is this next chart there. All the emerging markets are on the top. So the emerging markets GDP growth, which is the national income of that country, is all between like 4 and let's say 8%. But their markets did not do that well. When we look at the bottom chart there, you can see the developed markets. That's the US, UK, Europe, etc. And our year-over-year growth has been around 2% or so. But yet our markets did almost in the high 20s. So there's a disconnect between the growth of the magnitude, I would say, between what's happening with the GDP, but also the particular stock markets. And a lot of that has to do with, is it already overpriced? Did it go too fast and now something else is trying to catch up to it? Or so that kind of concept that the economy does not necessarily mean that the market is going to do exactly the same. One thing I want to throw up on the chart again is the annual returns per year going back, a good long time, a good 25 years, 26 years, and over 30 years, my mistake. And you're going to see that most years, those red numbers down there, most years there's a decline of a double digit. So now let's kind of talk about 2014. It is difficult to make a prediction about the future, okay? It's just that simple. And frankly, I'd avoid the whole thing if I could, but everybody expects it. And I think that we need to take it with a grain of salt. And this is going to get back to our discipline here in just a little bit. I am optimistic for 2014 and 2015. I stick stay behind what I said 12 months ago, which is that we ought to have good managers. They're going to take advantage of some trading ranges. And if we have a tailwind like we did last year, great. We've positioned ourselves to be a part of that because we have a diversified portfolio. If 2014 turns out to be negative, well, then we still need to have some equity exposure because we might we want to have some bond exposure because I believe the bonds will do well if the stock market does poorly. And so as we create this portfolio together, I think that we ought to probably increase our equity exposure in general. That's what I'm doing in general, but each client is specific. And please don't make changes if you're not a client of mine without talking to me or really talking with your specific advisor. But if you're one of my clients, you know that I'm going to be talking with you about that. But we've got to be disciplined in regards to not getting crazy. I mean, if the thing that makes sense for you and your goal is to be a conservative investor, don't start going towards, I want to go all equity or I want to go aggressive, etc. Because one of my jobs with you is to be a behavioral finance guy, meaning that the exuberance and the excitement to say, oh my gosh, let's double down, let's go all in. Real investors, unfortunately, many times buy at the top of a market and sell at the bottom of the market, and we want to be the smart money and not do that, okay? We want to be the smart money and many times invest and stay disciplined to our to our plan, even when we've got some bright, shiny object or a new diet plan has come up, etc. We want to kind of stick, make adjustments. That's what I'm doing with some of my client portfolios, is making those adjustments, but also sticking to what we have, which is a diversified portfolio, perhaps a little bit more equity exposure, but not getting crazy on it. And the reason why I'm a little bit more optimistic going into 2014 and 2015 is the amount of cash that we have in there, the great efficiencies that we're having, that it's going to continue to play out, I believe, in 2014 and 2015 for companies. And I think that some of the tapering is not going to affect things as greatly as so many people feel. And so I think that's going to be maybe not a non-event, but not as big of an event as we think going forward. That's it. That's my year-end review. That is my kind of my 2014 preview. But my biggest thing is, let's stay disciplined. Let's have a good portfolio. If somebody reaches their goal before you, so what? You've got your goal, your plan, your risk tolerance. You stick to it. You stick to that particular plan. Might sound boring, but you know what? Sometimes boring wins the race. So anyway, Mike Brady, Generosity Wealth Management. Love to hear from you. 303-747-6455. You have a wonderful day. Thank you. Bye-bye.